Right now, we're witnessing something that should terrify any rational investor. NVIDIA, a company that makes computer chips, is trading at a market capitalization of over $3 trillion. Let me say that again, $3 trillion. That's more than the entire GDP of the United Kingdom, the sixth largest economy on earth. And yes, NVIDIA is genuinely revolutionary. Yes, their chips power the AI revolution. Yes, their financial results are spectacular. But here's what nobody wants to hear. None of that matters if you're paying a price that assumes absolute perfection for the next decade. I've been investing for over 70 years. I've seen this movie before, and I can tell you exactly how it ends. The question isn't whether NVIDIA is a good company. The question is whether it's a good investment at $3 trillion. And I'm here to tell you the mathematics of that proposition should keep you awake at night. Let me start by acknowledging what NVIDIA has accomplished, because I'm not in the business of attacking excellence. This company has genuinely transformed computing. Their graphics processing units, or GPUs, have become the essential infrastructure for artificial intelligence. When ChatGPT processes your questions, it's running on NVIDIA chips. When researchers train large language models, they're using NVIDIA hardware. When autonomous vehicles learn to navigate streets, they're powered by NVIDIA technology. This is real innovation with real-world impact. The financial results back up this excellence. In their most recent fiscal quarter, NVIDIA reported revenue of $35.1 billion, up 194% year over year. Let me repeat that. Revenue nearly tripled in a single year. Their data center business, which sells AI chips to companies like Microsoft, Google, and Amazon, generated $30.8 billion in quarterly revenue, up 217%. These aren't projections or promises. This is actual money flowing into the company's bank accounts. The profitability is even more impressive. NVIDIA's gross margins exceed 75%. That means for every dollar of revenue, they keep 75 cents after paying for the cost of manufacturing their chips. Their net profit margins run around 55%. In the most recent quarter, they earned $19.3 billion in net income. That's more profit in 3 months than most Fortune 500 companies earn in a year. They're generating over $17 billion in free cash flow quarterly. This is real cash that could be distributed to shareholders. The company dominates its market in a way few businesses ever achieve. They control an estimated 92% of the data center GPU market. Their CUDA software platform has become the de facto standard for AI development, creating switching costs that lock customers into their ecosystem. When Jensen Huang, their CEO, introduces new chip architectures, the entire tech industry reorganizes around them. This is market power at its finest. Major technology companies are in an arms race to acquire NVIDIA chips. Microsoft is spending billions on AI infrastructure, mostly buying NVIDIA hardware. Meta has publicly stated they're acquiring hundreds of thousands of NVIDIA GPUs. Amazon, Google, Oracle, they're all doing the same. The demand is so intense that lead times for their highest-end chips stretch 6 to 9 months. Companies are literally begging to give NVIDIA money. The company's roadmap shows continued innovation. They're moving from their current Hopper architecture to Blackwell, which promises even greater performance. Beyond that, they're developing Rubin and Vera architectures. Each generation increases computing power while improving energy efficiency. The technological moat appears formidable. So what's my problem? The same problem I had with Cisco Systems in the year 2000, with Amazon in 1999, with every spectacular company that reaches a valuation so extreme that future returns become mathematically impossible. The price, Charlie Munger used to tell me, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Right now, we're looking at a wonderful company at a price that defies reason. Let me walk you through the mathematics, and I promise I'll keep it simple. NVIDIA's market capitalization fluctuates, but let's call it $3 trillion. Their projected fiscal year 2025 revenue is approximately $130 billion. That gives us a price-to-sales ratio of about 23 times. Now, In my experience, price to sales ratios above 10 should make you nervous. Above 15, you should be very nervous. Above 20, you're in speculation territory. For context, Apple, the most valuable company on earth with $1 trillion ecosystem and customer loyalty that borders on religious devotion, trades at a price to sales ratio of about 8. Microsoft, which has near monopolies in enterprise software, trades at about 13 times sales. NVIDIA is trading at nearly double Microsoft's valuation relative to revenue. Let's talk earnings. NVIDIA will earn somewhere around $3 per share in fiscal 2025, with the stock trading around $140. That's a forward price to earnings ratio of about 47 times. Now, that's not as extreme as Palantir's 200 plus PE ratio, but it's still expensive by historical standards. The S&P 500 historically trades around 16 times earnings. Even during exuberant periods, we rarely see market-wide PE ratios exceed 25 to 30. But Warren, you might say, NVIDIA is growing earnings at extraordinary rates. You have to pay up for growth. Yes, growth is valuable, but let's do some arithmetic that nobody seems willing to do. Even if NVIDIA maintains, and this is a heroic assumption, 50% revenue growth for the next 5 years, we're looking at revenues of approximately $875 billion by fiscal year 2030. If they maintain their spectacular 55% net margins, that's $481 billion in net income. Now, here's where it gets interesting. With roughly 24.5 billion shares outstanding, that's about $19.63 per share in earnings by 2030. If you pay $140 today for those 2030 earnings, and then the market decides to value those earnings at, let's be generous, 30 times earnings, still expensive, you're looking at a stock price of $589. That would give you a compound annual return of about 33% over 5 years. That sounds great, right? Except we've assumed literally everything goes perfectly. 50% revenue growth, sustained for 5 consecutive years, maintained industry-leading margins of 55%. No significant competition, no technological disruption, no execution mistakes, and a premium valuation multiple at the end. If any of these assumptions prove even slightly optimistic, returns will be disappointing. If several prove optimistic, losses will be severe. Let me tell you why that 50% sustained growth assumption is probably fantasy. NVIDIA's law of large numbers problem is approaching faster than people realize. It's one thing to grow 50% when you're a $30 billion revenue company. It's quite another when you're at $130 billion. And it becomes exponentially harder at $300 billion, $500 billion, or $875 billion. Let's think about what $875 billion in revenue actually means. That would make NVIDIA larger than Walmart, which has taken 60 years to build $650 billion in revenue with stores in every corner of America and operations in 24 countries. NVIDIA would need to be larger than the entire global semiconductor industry is today, which generates about $600 billion annually. They would need to capture revenue equal to the combined totals of Apple, Microsoft, and Google today. Does that seem likely? The total addressable market for AI chips is large, but it's not infinite. Analysts estimate the data center accelerator market might reach $400 billion by 2030. Even if NVIDIA maintains their 92% market share, which is unlikely as competition intensifies, that's $368 billion in revenue from their core business. Where does the other $500 billion come from to justify the growth projections? The competition question deserves serious attention. Right now, NVIDIA enjoys dominant market share. But with margins of 75% and a market worth hundreds of billions, do you think that will last? Every major tech company is building AI chips. AMD has launched its MI300 series accelerators, specifically targeting NVIDIA's dominance. Intel is investing billions in competing products. But here's what should really concern NVIDIA shareholders. Their biggest customers are also becoming their biggest competitors. Google has developed its own TPU, tensor processing unit, chips for AI workloads. They're not buying NVIDIA chips for much of their internal AI work. Amazon has developed Graviton processors and is working on Trainium chips for AI training. Microsoft is designing its own AI accelerators called Maya. Meta has announced plans to develop custom silicon. These aren't small startups trying to compete with NVIDIA. These are trillion-dollar companies with unlimited resources and strong incentives to reduce dependence on a single supplier. Think about the strategic position here. If you're Microsoft and you're spending tens of billions on NVIDIA chips, paying 75% gross margins to NVIDIA, don't you have an incentive to bring that capability in-house? Every dollar you pay NVIDIA is a dollar that could be profit if you made the chips yourself. The vertically integrated model that Apple pioneered, designing its own chips rather than relying on Intel, is exactly what NVIDIA's customers are now pursuing. I've seen this pattern before. In the early 2000s, Cisco had a similar dominance in networking equipment. They had the switching costs, the market share, the technological lead. Customers had no choice but to buy Cisco. Then competition intensified, margins compressed, and growth slowed. The business didn't collapse, but the stock bought at peak valuations devastated investors. Let's talk about the historical precedents, because this is where experience matters. I want to take you back to March of 2000, because the parallels to today are so striking they should terrify anyone paying current prices for NVIDIA. The dot-com bubble reached its peak when the NASDAQ composite hit 5,048. Technology stocks dominated the market. Investors had stopped caring about traditional valuation metrics. They talked about revolutionary technology, about paradigm shifts, about new economy. Rules, price-to-sales ratios of 20, 30, even 50 times were considered reasonable for the right companies. Cisco Systems, which made the routers and switches that powered the internet, real products, real revenue, real profits, traded at a PE ratio of 472 times earnings at its peak. The company was growing earnings at over 30% annually. Everyone said you had to own it. The internet was going to change everything, and Cisco was the infrastructure play. The stock hit $82 in March of 2000. Then reality set in. The stock fell 89% over the next 2 years. It took 17 years to get back to that price. 17 years. If you bought Cisco at the peak, you waited nearly 2 decades just to break even. Or consider Intel, which actually was printing money with dominant market share in PC processors. Intel traded at a PE ratio of 50 times earnings in 2000. The stock fell 83% from its peak. It still hasn't reached its year 2000 high, and that was 24 years ago. An entire generation of investors has come and gone, and Intel shareholders who bought at the peak still haven't broken even. Oracle, another legitimate company with real products and profits, traded at a PE ratio of over 180. The stock fell 80% and didn't recover for 15 years. Sun Microsystems, which made the servers that powered the internet, went from a market cap of $200 billion to being acquired for $7.4 billion by Oracle in 2010. Shareholders lost 96%. But here's what's crucial to understand. The technology itself was revolutionary. The internet did change everything. E-commerce did become massive. Cloud computing, which these companies enabled, is now a trillion-dollar industry. The problem wasn't that the technology didn't work. It was that investors paid prices that assumed not just success, but perfect, uninterrupted, maximum success for decades into the future. The companies that survived and eventually thrived, Amazon, Microsoft, Apple, did so because they had business models that could grow into their valuations. But even these survivors punished investors who bought at the peak. Amazon fell 95% from its 2000 high. It took 7 years to get back to its peak price. Microsoft took 17 years to recover. Now let's apply these lessons to NVIDIA. The AI revolution is real. I don't dispute that artificial intelligence will transform productivity, just as the internet did. NVIDIA's technology is genuinely valuable, but that's exactly the trap. The best bubbles are always wrapped around real innovation. The South Sea Company really was involved in trade. The railroads in the 1840s really did revolutionize transportation. The internet really did change commerce, and AI really is transforming everything it touches. The question is never will this technology matter. The question is what price can you pay and still make money? At current prices, NVIDIA investors are assuming perfect execution, sustained 50% plus revenue growth, maintained industry-leading margins, no significant competition taking market share, no technological disruption, continued customer dependence rather than vertical integration, and continued high valuation multiples for years into the future. If any of these assumptions prove even slightly optimistic, returns will be disappointing. If several prove optimistic, losses will be severe. Let me show you exactly why NVIDIA's current valuation makes future returns nearly impossible even under optimistic scenarios. NVIDIA's market cap is roughly $3 trillion. Let's assume you want to earn a 10% annual return over the next decade, a reasonable expectation for equity investments. That means the company needs to be worth $7.78 trillion in 2035. For that market cap to be justified, what does the business need to look like? Let's be optimistic and assume the market will still award NVIDIA a premium 30 times PE ratio in 2035, which would still be expensive. That means the company needs to earn about $259 billion in net income. With their excellent 55% net margins, that requires revenues of approximately $471 billion. NVIDIA's fiscal 2025 revenue will be around $130 billion. To get to $471 billion by 2035, they need to compound revenue at about 13.6% annually for 10 consecutive years. Now, 13.6% growth doesn't sound impossible. But remember, we're talking about growing from $130 billion to $471 billion. In year 5, when NVIDIA is generating $245 billion in revenue, they'll need to add $33 billion in new revenue that year. By year 10, they'll need to add over $60 billion in a single year. That's adding revenue equal to half their current total every single year in the later years. And this assumes they maintain 55% net margins, which as competition intensifies and customers vertically integrate, seems optimistic. If margins compress to 40%, which is still excellent, they'd need $648 billion in revenue to generate that $259 billion in earnings. That requires 20% annual revenue growth for a decade. At that scale, with that competition, does that seem likely? But let's say I'm being too pessimistic. Let's say NVIDIA grows revenue at 25% annually for the next 10 years. Exceptional performance. That gets them to $1.26 trillion in revenue by 2035. With 50% margins, that's $630 billion in earnings, or about $25.71 per share. If the market awards them a 30 times PE, the stock would be at $771. You paid $140 today. That's a 15% annual return. Not bad, but you're taking massive risk, assuming perfect execution, and 25% annual revenue growth for a decade to earn 15%. You could earn similar returns with far less risk in other quality businesses trading at reasonable valuations. The risk-reward ratio here is completely inverted. You're taking maximum risk, paying peak prices at the height of AI enthusiasm for moderate potential returns that assume everything goes right. Now let's talk about what could go wrong, because when you pay 47 times earnings, you're not being compensated for adversity. If revenue growth slows to 20%, still exceptional, the stock could easily halve as the growth story moderates. If a competitor develops comparable chips at lower prices, forcing NVIDIA to cut prices, margins could compress from 75% to 60%, costing billions in market value. If major customers like Microsoft, Google, and Amazon successfully develop in-house alternatives and reduce NVIDIA purchases by 30%, revenue growth stalls. If China, which represents a meaningful portion of revenue, escalates semiconductor restrictions or bans NVIDIA chips entirely, billions in revenue disappear. If the AI build-out peaks sooner than expected because companies realize they're overinvesting in infrastructure, demand crashes. If a new computing paradigm emerges that doesn't rely on GPU architecture NVIDIA's entire moat evaporates. If they execute an ill-advised acquisition to accelerate growth into new markets, value could be destroyed. If Jensen Huang retires and succession planning fails, execution could suffer. Any one of these risks in isolation might be manageable. But when you've paid a price that assumes perfection, even normal business challenges become catastrophic for returns. This is the tyranny of high valuations. You've already paid for all the good news in advance. From here, the only surprises can be disappointments. The stock doesn't need to fall to zero for you to lose money. It just needs to trade at a normal valuation multiple when growth inevitably slows. Let me give you a concrete example of how this plays out. Suppose in 5 years, NVIDIA is generating $300 billion in revenue, still extraordinary growth. And suppose they maintain 45% net margins, still excellent. That's $135 billion in earnings, or about $5.51 per share. If the market decides AI growth is maturing and values those earnings at 25 times, still a premium, the stock would be at $137.75. You paid $140 today. 5 years later, after the company more than doubled revenue and maintained world-class margins, you've lost money. That's not a doomsday scenario. That's a scenario where NVIDIA executes well, but the valuation multiple contracts from 47 to 25 times earnings. A perfectly normal multiple compression that happens constantly in markets. And you lose money despite the company's success. The insider selling should concern you. Jensen Huang has been selling millions of shares through pre-planned trading programs. Now, CEOs sell for many reasons, and I don't automatically assume the worst. But when insiders are selling at these prices while retail investors are buying, it's worth noticing. The people who know the business best, who see the competition developing, who understand the challenges ahead, they're taking chips off the table. Some institutional investors are doing the same. Not fleeing entirely, but reducing positions, recognizing that at these valuations, the risk-reward has become unfavorable. These aren't retail investors panic selling. These are sophisticated institutions with teams of analysts who understand semiconductors intimately. When they reduce exposure, you should pay attention. And then there's the comparison to historical bubbles. NVIDIA's current valuation relative to the overall market is reminiscent of Cisco's peak dominance. At its height in 2000, Cisco briefly became the most valuable company on earth, worth more than Microsoft. Everyone said you had to own it. It was the arms dealer in the internet gold rush, just like NVIDIA is the arms dealer in the AI gold rush. The parallel is almost perfect. The fundamental lesson of investing history is that valuation matters. Not today, not tomorrow, but eventually. You can't cheat the mathematics indefinitely. When you pay 47 times earnings for a company, you're betting on a very specific future unfolding exactly as hoped. When you pay 23 times sales, you're essentially saying, I believe this company will dominate its industry, maintain exceptional margins, and grow relentlessly for many years. And I'm willing to pay in advance for all of that optimism. The investors who bought Cisco at 472 times earnings in March 2000 learned this lesson painfully. The company itself did fine. Cisco is still a major player in networking equipment today, but the stock devastated its shareholders. Those investors would have been far better off waiting for a correction and buying at rational prices, even if that meant missing some upside in the short term. I want to be very clear about what I'm saying and what I'm not saying. I am not saying NVIDIA is a bad company. They're exceptional at what they do. The technology is remarkable. The execution is brilliant. Management has delivered extraordinary results. In a different market environment, at a different price, I might find NVIDIA interesting. I am not saying the stock can't go higher from here. Momentum can carry stocks far beyond irrational valuations. In 1999, I watched internet stocks double and triple from levels I already thought were insane. Mania can persist longer than reason would suggest. What I am saying is this. At a market cap of $3 trillion, a forward PE of 47, and a price-to-sales ratio of 23, the mathematics of future returns have become prohibitively difficult. The current price already incorporates years of perfect execution, sustained exceptional growth, and continued premium valuations. There's no margin for error, no compensation for risk, and no recognition that trees don't grow to the sky. My advice is simple. Admire NVIDIA's business from a distance, watch their execution, marvel at their technology, but don't confuse a great company with a great investment at any price. The two are not the same. A Rolls-Royce is a magnificent automobile, but if I offered to sell you one for 10 times its worth, you'd recognize that as a poor deal. The same principle applies here. For those holding the stock, I'd encourage you to do some hard thinking about opportunity cost. What other investments could that capital flow into? Where else might you earn reasonable returns without assuming everything goes perfectly for years on end? Sometimes the best investment decision is recognizing when something has gotten ahead of itself and moving to safer ground. This isn't market timing. It's simple recognition that valuation matters. Eventually, always, inevitably, it matters. I'll close with this thought. In 1999, at the height of the dot-com bubble, Berkshire Hathaway stock was falling while internet stocks were soaring. My shareholders were frustrated. People called me old-fashioned, stubborn, out of touch. But I knew something they'd learn later. I'd rather be approximately right than precisely wrong. I'd rather miss out on gains I don't understand than participate in losses I should have seen coming. When the crash came in 2000, those boring investments I held, the insurance companies, the banks, the consumer businesses trading at 15 times earnings instead of 150, they didn't collapse. They steadily compounded. The investors who mocked my caution in 1999 were begging for my prudence in 2001. I see that same setup today with NVIDIA. It's a wonderful business, but at 47 times earnings and 23 times sales, it's priced for perfection in an imperfect world. The AI revolution is real, but so is the mathematics of valuation. And when those two collide, revolutionary technology meeting absurd prices, history has been unambiguous about which one prevails. Stay skeptical, stay disciplined, and remember, in investing, survival is the first priority. Only then comes prosperity.